All right, it looks like we're live. So welcome back to SelfWealth Live. My name's Owen Raskovich. Always a pleasure to be with you on a Monday at midday. Thanks for everyone that's already tiled into the SelfWealth Live. If you need to ask questions and you haven't been here before, the easiest way, g'day Vico, is just to do what Vico did and jump into the comments section there. And with me today, I've got Nicholas, who will be on standby to help you with any support questions. But if you do need some support, if you need to place a trade or check an order status or something like that, you can log into your SelfWealth account, or you can jump onto the live support channel, which is available at selfwealth.com.au. You'll see a widget down the bottom corner there. Just click on that one and the team will be able to answer your support or account related questions. Cool. So we've got some great questions coming through. I'm assuming everyone can hear me then, which is a nice thing. Today, just to give you a bit of run through of what we're going to go through, we're going to take a look at a company that you wanted me to research, which was Netflix. So we're going to go through that together today. We're also going to talk about a 5-point checklist, an investing checklist. So ways that you can go about researching your own global or ASX stocks. And I'm going to show you how basically I piece together my investing so then you can do it yourself. We're going to look at some quarterly numbers, and we're going to also dive in here into the SelfWealth platform and look at how we can understand management's effectiveness, the moat of a business, and how we can analyze different companies. So we'll start with some global companies here, Netflix, but we'll also talk about some ASX companies that you'll hopefully throw into the chat function. So just to recap, so what is SelfWealth Live? Well, SelfWealth Live is an opportunity for you and me to catch up and talk about investing for 60 minutes every Monday. We're a few weeks in, and all of the lives that we've done before are available on the SelfWealth website. If you just hit on the blog there, you'll see some of the latest updates, but you can also subscribe to the SelfWealth YouTube channel, which is obviously free, and you get notified instantly through the YouTube app when we go live. So some housekeeping, of course, any questions that I answer are limited to general financial advice only. It's pretty simple. I don't understand your goals, your portfolio, your situation, so I can't give you specific, tailored, or one-on-one personalized advice. I can only give you general information. And I'm going to talk about companies, we're going to talk about valuations and all that good stuff. Just remember that investing can be risky, and nothing that you hear here is a guarantee or some sort of, a surety that something's going to happen in the future. I always say that investing is risky. If it wasn't risky and there wasn't the chance that you could lose some money, we would call it saving. So this is a chance for us to talk about companies, to talk about one of the most exciting companies in the world. If you need to find out more about the legal stuff, you can head to Rask Australia's Financial Services Guide. That's an FSG. You can find that on our website. Who am I? I'm Owen Rask. I'm an analyst, and I'm a founder of a company called Rask Australia. Okay, enough of that stuff. Again, if you have your questions, chuck them in. Scott Brown said, "Hey Rask, what are your thoughts on A2 milk as a buy?" Why don't we, Scott, I'm going to pencil that down because I like to talk about A2 milk. So I'm going to pencil that down for later on in the chat, and we'll jump into the SelfWealth platform and have a look at the results because I actually haven't circled back to it in a while. So great question. Nice telescope. Yes, you'll see that I mistakenly left the telescope in the live today, so apologies about that. Yeah, it's a bit of fun. I love to do that on weekends. And with the space race on, I'm sure there's some companies that we can invest in, like Virgin Galactic and plenty of other companies too, if Elon Musk or Jeff Bezos ever let us get to it. Okay, so we're going to swap over to the screen share here, and you can see that I am in the SelfWealth platform. We can search for stocks just like anytime we want to search for stocks, we can just chuck it up the top here and we can find a company we're looking for. In this case, I know what the Netflix ticker code is, NFLX. What I find really cool about the SelfWealth platform, which is, in my opinion, it's probably unparalleled in Australia, which is the ability to traverse between global stocks like this, A2 Milk, ASX stocks, A2 Milk, which is actually a Kiwi company listed in Australia, and global stocks. I think it's really cool. Anyway, so let's start with, hello again, Cameron. Hello, Domable. Love it. Welcome back. And Plant One, of course. I know you asked all the good questions last week, so I'm glad that you're back, mate. So yeah, Netflix. Well, we all know Netflix. Netflix does streaming on the internet. And what was really interesting as I was doing some research for today is to know that up until 2020, I think it was, there was still over 1 million people who used Netflix DVD hires. So Netflix started as a business that you would order DVDs online and they would send them to you, because that was before, we had broadband internet and all that. And they would actually send you the DVDs. And there was a company in Australia at the time, a company that I invested in. This is like Netflix was first. There was an Australian company called QuickFlix. QFX was the ticker code here in Australia. And I think it ended up going bust because it just couldn't compete against Foxtel and all that. But Netflix was started by a guy called Reed Hastings. And one of the, if you're really interested in what makes really strong businesses keep going, I think we're going to talk about a 5-point checklist today, but obviously management matter, right? So, hey Chris, thanks for the comment. We've got Fortescue. What I might do is I might actually chuck that on the list too for later on the chat. Roblox Edit Girl just put the same comment in the chat. So both awesome. Okay, so back to Netflix. Netflix started as a DVD rental business. You would order your DVDs online, they'd be cheap. And because the reason that DVDs worked, right? People had a similar idea before, but the reason why DVDs worked is because when it comes to posting, right? When it comes to posting a DVD, it's very thin, it's very light, so it was very cheap to post that to a customer. Whereas in the past you had VHS. If you remember VHS, I'm sure many of us do. VHS was a bit thicker, a bit heavier, a bit bulkier, and it was, in some ways, it was more fragile than a disc that could be protected via just a rectangular encasing. So Netflix would post these out to people, and then they would hopefully send them back for a rental fee. So this business has evolved many times over the years, and what's really interesting about Netflix is that it has grown through lots and lots of changes. So if you remember back, I just said it's been posting DVDs. It fought off Blockbuster, and I think one of the actual I could be wrong about the exact numbers here, but I think Netflix actually got a takeover offer from Blockbuster. I think it was around $50 million, or at least that's what they were pitching for. And Blockbuster said no. So, and now for $50 million, and now you look at it, it's $261 billion. So jokes on Blockbuster, because here we have Netflix, which is just reigns supreme. Okay, so that's what we know what Netflix does. It does streaming. Now, what's really interesting to take you right up to speed is Netflix actually is now in an environment where it competes substantially against other big players. So we've got Apple, it's just entered. We have Disney, we have Hulu, we have all of the streaming services. So ESPN even has its own streaming service in the US. All around the world, there are things like Stan and Binge, which are competing on a geography by geography basis. So one of the things that we would look at here is we would come in and we would look at the latest announcements for Netflix, and we could come in and we could find the quarterly. If we scroll down, just keep hitting load more and then you'll find the quarterly. But I've got it up here, I've preloaded it for us. This is the latest quarterly. And like all good tech businesses in the USA, what they do is they treat investors like us as if we're actual partners in their business, which is pretty rare for here in Australia. Okay, so we've got some wonderful. My bank balance from my bank account resembles Blockbuster. Well, Stevie, if you were turning down a $50 million offer, I'd say it's a pretty good bank balance. But if it's maybe Blockbuster today, maybe that's not a great thing. But anyway, so here we go. We can see the quarter over quarter. It looks like the gods at Netflix have actually just taken a bit of a screenshot from their Excel spreadsheet here. But so here we've got pretty strong growth year over year. So we can see here in Q2 2021, we've got 19% growth. Now this is year over year. So what we're comparing in this one right here is we're comparing this quarter to the quarter a year ago. So where it's got Y/Y, if it had Q/Q, it would mean by the previous quarter, just to clear that up. So what we're actually doing is we're comparing this revenue item here to the revenue item from the Q2 2020. And why I single this out is that you get seasonality in some businesses, and some analysts actually forget that what we're comparing is not quarter over quarter growth, we're comparing year over year growth. And so the year over year growth is actually a better reflection. Now, was this a good result? Well, we'll have to know more about the business in a minute, but I just wanted to throw this in here that 20% growth is actually incredible when you think that a year ago in the United States, which is where I think about 80 million of their subscribers are from, a year ago in the United States, everyone was at home and wanted some entertainment, so they went to Netflix. Whereas a year later, the USA is largely out of COVID, and they're out and about, they're doing things. We've seen companies like Pinterest and Amazon and others make mention of people getting out and about again. So this growth is actually coming despite the North American market actually coming out of lockdown, which would mean that they're away from their TVs and those types of things. So it's actually pretty strong. Now, I said to you there was going to be a checklist in today's live stream. So, I am hiding some figures in my video. Oh yes, sorry, 1 second. I will get onto that right away. So let's see if I can bring that down. I'm just going to make me a little bit smaller here. And let's see if you can see what I'm looking at. Okay, so back to this 5-point checklist. Now, I don't actually have a notepad in front of me. So what I might do is I might just explain to you some of the things that I look for when I'm starting my research on a company. Stevie says, if The Mandalorian Season 3 comes out, I expect more viewership and growth. Yes, but Stevie, remember the Mandalorian is actually on Disney. So Disney's a different one. So Disney's actually competing for the same wallet, if you like, that same share of the pocket. But The Mandalorian is great. As you can imagine, I'm a fan with this telescope in my back right shoulder here. Okay, so here we go. If we actually look at what Netflix is doing, we can actually see, there's been some really strong growth. The number of net adds to the platform have been pretty incredible considering how fast it's growing. You can see this light blue line here is from COVID. And you can see the other years, it's still growing really fast. I don't know about you, but you can also see as it scales, it's getting better operating margin, which we'll come back to in a sec. One thing to note about companies like Netflix, guys, is that they have to spend a lot of money to keep up with the demand. So yes, we all know Netflix original series are great. If you've seen things like Stranger Things, one of my favorite ones was Mindhunter. And Mindhunter is actually a really good example because Mindhunter, which was this fictional remake based on serial killers, actually from the famous serial killers, and profiles 2 FBI operatives, and one of them's name is Holden Ford, and I thought that's ironic because in Australia those are the 2 prominent car makers if you're a fan of Bathurst and all that. Anyway, what's interesting is that Netflix actually stopped producing Mindhunter because it was too expensive. It was set back in the times of I think it was the 70s, I believe, and 70s or 80s. And at the time, when you can imagine on a Netflix set that there's the 70s and 80s cars, there's the clothing, there's the houses, there's everything. So the sets are actually really, really expensive. And so Netflix said, this is too expensive. We can't keep doing this. So here's a great one. So share of total US TV time. And we can see that cable is still very, very popular in here. And we can see the market share. I always like to check Nielsen down the bottom, or whatever the source is, to see where they're actually getting it from. A lot of these companies will actually pay for the market research, which I always find a little bit dubious. So we can see here the share of the market, which is really interesting. So Netflix is a lot bigger than probably the 2 scariest competitors, who are Amazon Prime Video and Disney. Jessica Jones, best Marvel spin-off on Netflix. Huh, okay, interesting. Yeah, Stevie, I agree with you. Mindhunter Season 1 it's a bit dark, it's creepy, but it's brilliant. If you've got some other recommendations, I am actually taking recommendations. I've just run out of seasons to watch. So back to Netflix here. So we can see 7% share, which is great. Now, you can see there are other streaming organizations that are coming up. You can still see that cable's really interesting here. And there was actually a note that I find, like if we're researching a company, we'll come back to the SelfWealth platform in just a minute, but Netflix streaming, one of the things that people struggle to do when they're talking about the industry that a company operates in and getting to grips with I'll wait for that to load, but I'll come back. They can actually struggle to find out who the competitors are. And so here we can see Netflix, Hulu, Prime, Disney. These are all companies that you can invest in by just going in here. We know Amazon's ticker code because it was in the chat last week. We can see, Amazon in here too, but we'll just go back to Netflix. And if this is loaded, it still hasn't loaded. Statista is a really interesting website. It helps you come to grips with. It's as I say that the Statista website looks like it's a blowing up today, so we won't go there. But clickbait is good. Where was I going with this? Well, if we start our research, we can actually look at the quarterlies in the SelfWealth platform, and then we can find things like this. We can read through management's discussion, find the competitors, and then add them to our watch list. Okay, so I'm going to give you my 5-point checklist. My 5-point checklist is actually really simple. The first one is it within your circle of competence? Which means that you've got to ask yourself, like my background is in computing and technology. I'll switch over to the main screen here. My background is in computing and technology. I actually studied information technology at university. I did economics as well, but then I moved on and I did 2 degrees in finance, 2 master's degrees. And so that's the first base of determining what your circle of competence is. What do you know, basically? Now that's where I am, but I always say to people, like a taxi or an Uber driver, you might understand ride sharing, and ride sharing companies are exploding. So which companies should you be researching? We should be researching those companies first, because they would be in your circle of competence. The further you go outside your circle of competence, the more likely you are to make a mistake. The second thing that and that's only like education and experience. Another thing that you could focus on to determine your circle of competence is what you are passionate about. If you're passionate about horticulture or agriculture, go and find the companies that operate in those industries and do it first. When you go into your SelfWealth account, just looking to see which sector it's in. And start there and then work out. That's Warren Buffett's great secret, is stick to what you know and find the companies that aren't not necessarily growing, but are just going to be here in 5 or 10 years. If you can be reasonably sure that a company will be around in 5 years, that's a great first step. So Warren Buffett also calls them 1-foot hurdles. So he doesn't look for 5-foot hurdles to jump over, he looks for 1-foot hurdles to step over because he's sure that he's going to get a return for his money. So I've said circle of competence, that's where we start. Now in my business, we start with technology companies, and I'll get to some research on this in a minute. The other thing that we look for is management alignment. So we look for skin in the game, lots of share ownership, lots of long-term incentives. We'll get to that in just a moment for Netflix. We look for a competitive advantage. Now, there are different ways to measure competitive advantage, and we'll look at that in the SelfWealth platform in just a moment. But a competitive advantage is the reason a business can charge more money for its products or services than it costs to service them. So, for example, I always use the example of 3 cafes on the street. They all sell the same coffee, they all have equally good baristas, and they all have the same, trendy culture vibes and all that sort of stuff. Now, if one cafe put its prices up from $4 to $4.50, you would just swap from that cafe to the other cafe and you would do your business there. And so that business that puts up its prices has no competitive advantage. Now, this is really important for Netflix, so we'll come back to this in a minute. But the true sign of a competitive advantage is the ability to increase prices and keep your customers. I'll get back to why that's important in a minute. The other thing that we look for, and this goes back to a couple of weeks ago, is valuation. So we're looking for reasonably valued companies. I'm not in the bargain bins looking for companies that are like on a PE ratio of less than 5 or less than 10 or huge dividend yields. I'm looking for quality companies that I can purchase at a reasonable price. So those are some of the things to look for. And the final thing, which I've added on in recent years, which is what Warren Buffett and Charlie Munger have done too, is we're looking at industry growth. So is the industry growing as a whole, and is the company growing within that industry? Some great some great tips coming through here. OSARC, yeah, I like it. Really, really interesting. OSARC's actually a good, it's about money laundering. So if you're into finance, it's probably what you'd look for. So great tip there. Okay, so let's jump back into the platform and let's start going through those criteria and looking at Netflix. So if we jump into the SelfWealth platform, what we do here is we can look further down. So this is on the, for those of you that may be listening, we're on the ratios page here. Like, so you click on the stock, NFLX, Netflix, you go to the ratios tab, and I'm going to minimize this one. And we're going to go down to management effectiveness and margins. Okay. So here, what we're looking at is we're looking at things like, I'm just going to zoom in a bit, I think, and then I'm going to scroll down a bit. So here we can see the gross margin for the trailing 12 months is 44%. So this is what does Netflix get in revenue minus what it costs to serve that content and to serve those users. So this is at the very top of the income statement, revenue minus costs. And we can see that we have 44% margin, which is really good. Now, if we go down further to the net profit margin, this is at the bottom of the income statement. This takes into account not only the costs, but all of the expenses, things like R&D, research and development, marketing. It takes into account everything. So here we can see the net profit margin for the trailing 12 months is 15.6%. So when people talk about profit margins, they often talk about this margin. But for me, this is arguably the least valuable margin of all of them. This is the one I pay the least amount of attention to. Why? Because if you're investing in a growth company, I just said like this 44% margin, if Netflix got $100, if you gave Netflix $100 of your business today, they would, after putting, running the servers and putting electricity on, they would keep $44 of that. And then they would pay for things like investing in new content or research and development or marketing. And then what they'd have left over after all that is this thing down here called the operating margin. See this here? In Australia, we call this the EBIT margin, but in the US, they call it the operating margin, 22%. So we've gone from costs, just excluding costs, now just excluding expenses. But then to go to the net profit margin, this is where we exclude things like tax and interest and weird accounting things that don't relate to the core of a business. So we want, in my opinion, if you're looking at the health of a company, look at, first of all, the gross margin, because that tells you, can this business make more money as it brings in more revenue? Further down, we're looking at this one right here, which is the operating margin. And this is saying before tax and before we pay our interest bill to the bank, what are we making? $22 per $100. So that is, I want to focus on that margin for a very good reason in just a minute. Now, if we come further down the platform here, we can see, and I'll just bring it up here quickly, which is the operating margin of 5-year average, right? You can see that here. 12% is the 5-year average. But in the last 12 months, it was 22, so it's gone up. So why has that gone up? Now, if you ask me, we haven't looked at the numbers yet, but the reason it's gone up is because as Netflix has grown, it could bring in more subscribers, and the costs, like research and development, content costs, etc., can be spread out amongst more users. So the costs, as the business grows revenue, hasn't grown as fast. So we're seeing that operating leverage, which is what it's called, play out now. And so if we come back up here in the quarterly, we can see it right here. So we can see the annual operating margin is on an upward trajectory. And that's what we want, because that means at the end of the day, we're going to get more profitable as we grow. So this is a really good margin that I look at. So is this one right here. I also want to look at things like, we'll get down to management effectiveness in just a second, but things like revenue growth. So if we come down, where is it? So we've got like, well, this is absolute revenue, but I want to look at revenue growth. Here we are. I'm hitting it on myself. So we can see revenue growth, 19.4% here. We can see earnings per share growth rate here, 83%. We can see revenue growth over 5 years is a whopping 29%. Imagine growing your business by 1/3 every single year. Well, that's what Netflix has done. And so this is an out and out growth business. We know that. So here we've got growth, And when combined with a wide gross margin, that means that more dollars are flowing through to Netflix coffers every time it brings in another dollar. Now, if we come down to management effectiveness, there are some really interesting things here, but there are some things that you don't want to pay attention to for a company like Netflix. One of them is you don't want to pay attention to return on average assets. Netflix doesn't have a lot of assets. It sells intellectual property. It doesn't sell, it doesn't have factories. It doesn't have those types of things. So we want to look at things like return on investment, which takes into account all the capital inside the business. This is a really, really interesting one. I actually went through last weekend and looked at companies that have a net income per employee. So this is profit per every employee that they hire. And so you can see here, $457,000 of profit for every employee in the business, which is huge. So really, really interesting. Really, really interesting. At Facebook, Amazon, Netflix, Google, all these companies have huge amounts of net income per employees because they're technology businesses. Now, so there is this idea of getting companies that are really high quality comes back to something that I mentioned before in our checklist, which is finding companies that have competitive advantages. And one of those companies is, one of those industries that you want to be focusing on is all of these three on this left-hand side here. So I'm just going to type something in here. You drop a general disclaimer info. And so here we got wide moats by sector. So this comes from a Morningstar research paper that came along quite a while ago. I think this was 2014, 2015. And this pie chart actually shows that based on the research done by Morningstar, where are the companies found that have really strong competitive advantages? So companies that have really, really wide moats means that they're really defensive businesses. So here we can see, and I'm just going to be quick here, but we can see that the companies that have the strongest defensive positions, so those real strong businesses, are companies like in the industrial sector. So things in Australia might be like ARB or businesses like Reese Plumbing, they would be in here. We've got utilities. We've got utilities, so things like AGL. We've got in the green, we'll have financial services like banks. In the yellow here, we've got consumer defensive, which might be like toilet paper, which is a special one during COVID. And this lighter shade of brown up here is actually the technology sector. And what Morningstar have found is they've said, well, the companies that achieve the best returns on invested capital or returns on investment right here tend to be the companies from technology, consumer defensive, industrials, utilities, and financial services. So if you think about that, some of the things that aren't in there are things like energy companies, like companies involved in energy generation. Companies involved in mining aren't in there because those companies tend to be competed away a little bit. So something really interesting. So Netflix would fall straight into this technology division, technology sector right here, this lighter brown. Just going to confirm that everyone can still hear me. Haven't had any questions coming through, so I'm just assuming everyone can still hear me. I hope they can. So the other thing that we would look at with a company like Netflix is obviously who's in charge of it. So we want to focus on companies that have good management teams. And the way we can kind of get a finger on the pulse is just by looking at, great, thank you guys for responding to me. I wasn't sure if anyone could still hear me. I was like, you guys have some questions? What's going on here? Come on, I want some interaction. You're just scaring me. You're scaring me with all the internet troubles I've had lately. Okay, so what was that? That was a good question from Bishal. Where can we find the PE ratio for these industry sector? That's a great question. So the way you can do that is typically you can find the index or you can go to an ETF. So what would be a good one? So you can find obviously PE ratios on the sectors, and you can find like interesting numbers in here. Probably the easiest way is to go to like the S&P ASX 200 website and find out what it is on there. I know that say like let's try this, IBV ETF. In here, never mind that stuff. So if we go in here, this is the S&P 500. So this is the US stock market index, and hopefully this web page loads properly for me. But we can actually find out, and I'll let this load here, we can actually find out a lot of the different data points in here. So fun facts. So if we come in here, we can actually see things like, where are we? The number of holdings, the price to book ratio, trailing 12-month dividend yield, etc. So you can go there and then stay in here for things for each individual company. So you can use the SelfWealth platform for companies, and you can use the ETFs as a proxy for what's going on in the industry. But really, so just on that, Bashar, I want to make something really clear, is that I almost never ever use the PE ratio to determine if I should invest in a company. Now, this, Bashar, comes back to the point that I was trying to make earlier on, which is that if we look at, say, like, let's look at Netflix's quarterly. So in here, this is Netflix's quarterly report, and what we can see is the revenues, right, are up the top here. So we can see for the 6 months it made I'll zoom in a bit, made $14.5 billion of revenue. But if we come right down, this operating income line is that operating margin that I talked about, the EBIT margin. So you would divide this by this. But if we come all the way down the bottom, we've got interest expense, then we've got our taxes, and we get this. What we're doing with the PE ratio is this is the E. This part here, the earnings, net income, they divide it down here so you've got your own version. By the way, guys, if it's me, I only ever look at earnings per share in the diluted one down here, because that includes options and other weird shares that management have paid themselves. You notice that it's lower? It's lower because there are some weird shares that you and I probably can't buy, so I'd use that one. And it's also available in SelfWealth. And so, Bashar, one final thing on this is that the reason I don't like the PE ratio that much is because for a company like Netflix, its earnings can change really quickly from one quarter to the next, because they might be spending a lot of money one year on marketing or investing back into the business. So you don't want to rely on the E being every month being super accurate. If we come down to growth rates, where is it? So we can see here earnings per share, most recent quarter versus a year ago quarter of 87%. So that means that the E in PE ratio is going to change by as much as 87% in 1 year, which may not necessarily tell you if the business is still a good investment. It just tells you that the PE ratio has changed. Okay, so so instant payments. I hope you guys saw the announcement this week, actually from SelfWealth, which was really, really cool. Instant payments are a great feature. So the next thing that we're going to look at is, we know that Netflix is growing fast. It's got a really good operating margin. Now, that's really important, because if we come down again, I just want to bring up this one more time. So if we look at the margins, if we look at the operating margin, what that actually tells you guys, now this is very interesting. What the operating margin tells you is, after we've said and done everything, we've paid for our costs, we've paid for our marketing, we've paid for our expenses, how much money does this business actually make? And what we can do is we can compare this in financial jargon. I'm not going to go super deep on it right now. We've actually got a course on this on our website. But the operating margin can be compared to the debt that Netflix uses, otherwise known as the cost of capital. Now, you'll see here that it's got only a little bit of debt, which is really, really strong. So it's got really it's got a little bit of long-term debt, but $14.9 billion is really not that much for a company like Netflix. But you can compare this amount of money to the cost of debt on the balance sheet, and you get that by going into the annual report, or the 10K in the US. So we call it an annual report here in Australia, they call it a 10K in the US. You can use the SelfWealth platform to find the 10Ks. And what I want you to remember about this little thing, right, is imagine that I'm sitting in front of you right now. Actually, I am sitting in front of you right now. But imagine, I'm going to switch over to the main screen here. Imagine I've got a cash box, right? It's just like a little box, and it's sitting in front. I put it in front of the table, and you put $50 into that cash box, and then a year later, you take $60 out. You've made a return of $10 on that, putting your money into that cash box, right? Now, investing in companies with wide moats is just like investing in that little box, right? As investors, we don't get that in our pocket, but the company can kind of keep that money inside and can keep compounding it. And that's this operating margin. What it's telling you is for every dollar that we get in for revenue, we can keep that inside our cash box and invest it again and again and again and again. And that is why companies like Netflix, Facebook, Amazon, all these beautiful technology companies, they have this cash box, and they take your money as shareholders or from the bank, and they put it in their cash box, and it keeps spinning, spinning, and spinning. And eventually the cash box grows bigger and bigger and bigger until it can't fit anything more in. And that's when a company gets like enormous, like these companies, and they pay out dividends. Eventually, or they do share buybacks. And that's what we're trying to find here, is we're trying to find companies with huge operating margins in the future, right? Keep that in mind. So if we come back here, if you looked at a metric, where are we? I swear I'll get there. Here we go. If you look at a metric like the operating margin in 2016, you would have said Netflix it's not a profitable business. It's only got a 4.3 operating margin right here. You would say it's a terrible business. But if you actually looked at the way revenue growth was going and the gross profit margins, you could see that going up over time. What you would find is that eventually the business grows to a point where it's got a really good operating margin because it's kept all that money inside the business from that really wide gross margin, the really wide EBIT margin, and it keeps going up. Okay, what makes you invest in a near fair value stock like Netflix? This is from AG Newer. Is there any upside potential? Then how much? How do we have to look more to the qualitative factors than the quantitative factors? Yes, AG Newer. So what I do as a long-term investor, right? One of the ways to think about these metrics here, which are fantastic, by the way, like to have all of this data as part of your account inside SelfWealth is like, it's awesome because a finance professional like myself, I have to pay a lot of money to get good data like this. Like I have to pay a lot of money to access tools like this. So anyway, that's an aside. But if you look here in the numbers, right? These numbers on the page here come from the quarterly, which you can access through Netflix, through SelfWealth as well. Those numbers come from here, right? This is to answer your question, Ewan. Then, where did these numbers come from? Well, these numbers come from going to Netflix.com and paying for a subscription, right? But we don't. How many people visit the Netflix website? Well, we could go to something like Alexa site rankings. So you can use this as a free hack that you can use. You can use the Alexa website to do your research. And so this is a way of answering your question, AG Newer. These are all qualitative factors because the qualitative factors, the things you can't put a number on every single day, are the things that lead you to getting those qualitative factors. So, I'm on the wrong one. Sorry, guys. Here we go. So we're on Alexa.com. And so here we can see, sorry guys. So here we can see on Alexa, we can see the website rankings for a company like Netflix, right? So you can see this now. Sorry about that. And so if we come down, we can actually see how popular the website is. We've just got the free version here, so we don't have any other stuff. But you can see that this site is ranked 20 in the world, number 18 in the United States. And so here we can see all of the different stuff that we want to see about how people get to that website. So AG Newer, what we're talking about is how do we predict what numbers are going to be shown in SelfWealth in 2, 3, 4, or 5 years. And the way you do that is you have to use your imagination to predict what might happen in the future. And to answer your question about valuations, so if we come through into the forecast page, right? Here we are on SelfWealth, and we can see this forecast is based on, different estimates of what the future value of a company is worth, right? And so we can see a range here. We can see the recommendations of what are the targets for earnings per share? What are the targets for the stock price? We can see the financial forecast, which is brilliant. This is brilliant, right? But what we need to be mindful of is focusing on the true growth in the business longer term. And the way we do that is we say to ourselves, okay, revenue is going to grow. That's what we can see in this line here. We can see EBITDA is going to grow according to, this is in the past, this gray area, and then we've got the gold area. And we've got to determine, in week 6 for the SelfWealth Live, we're actually going to do a full valuation. I'll take you through how I do it, and we'll look at that. But what we've got to determine here is, if this business is going to grow, how much is it going to grow in the future, and how much are we willing to pay for that? So a way to think about this is, if analysts are forecasting this much revenue in the next 2 years, we'd have to imagine, what are they going to forecast in 3, 4, or 5 years? So Nick, I'm just responding to Nick in another chat. Just generally. Okay, so just so I have to do a reminder, guys, just so you know, this is general advice only. So Netflix is a great company, but anything that I say is limited to general financial advice only, and that applies for both anyone using SelfWealth, but also anyone that uses our services or my services at Rask. So here we can see, I would rather pay a higher valuation for a company that is growing fast than pay a lower valuation for a company that's falling away. So this is a really bad way to explain it, AG Newer, but basically what Charlie Munger taught Warren Buffett something very profound quite a few decades ago. And Charlie and Warren talk about this often at their annual meetups. What they actually found was that you're better off paying a good price, so not a great price, but a good price for a wonderful business, a business that can grow fast like this, than you are paying a great price, like a bargain, for an ordinary business. So a business that's not growing fast. Think about it. People talk about, I'm going to get a 60 cent dollar. Yes, but what happens if you're wrong about your valuation, and that dollar that you thought that you were getting a value is actually only 50 cents? You were wrong. And so that happens a lot in investing. I see these really overconfident investors say, my valuation for Netflix is $601.22. And then 3 years later, the company is trading at $800 a share. That's not a forecast, it's a example. And then they were supremely overconfident. So what I would rather be confident in, AG Newer, is finding the great business in the first place. In my opinion, if I just go to where people are buying great companies and growing great products and services, I'm going to focus on that first and foremost, because there's actually a bit of, I'm going to get a bit geeky here, but actually the valuation of shares should actually go up every year, all else being equal, because of the cost of capital. Okay, so I'm going to move along here. The other thing that I want to impress upon you guys, so I've given you this as a free resource to use. You've obviously got all this wonderful data in here. Another thing to look up for a company like Netflix would be the management team. And the easiest way you can do that is you can head to Netflix and you can look at the jobs and things that they're hiring. You can look at their focus on the environment and the leadership and the directors of the business. You can get this information elsewhere as well, but the proxy statement is a great place to start. You can see who's in their team, what is their background, and obviously what I want things like, where is he? Here he is. Co-CEO and co-founder of Netflix in 1997. So Reed Hastings has written a brilliant book, and it's a fantastic book. Netflix was also the pioneer of something. If you look into it deep enough, you can actually go to something called Netflix Culture Deck. So the Netflix Culture Deck, and it actually was very, very ahead of its time. and it actually copped a lot of criticism because it actually was so bold at the time that people thought this can't be allowed. And you can actually come in here and see that the reason why Netflix has been a success is because they foster things like freedom and responsibility. So they seek excellence. They seek high performance. There's all these different things. And these are things that you can get online if you just focus on business culture. And another hack that you can use is you can use Glassdoor, or if you're in Australia, use the Seek website, Netflix. And you can see on Glassdoor, this is an employee review system. And you can see what people care about at Netflix, the approval rating for the CEO. So a 4.2 rating is actually super impressive. And that highlights to me the importance of management. So here we can see, all of the employees just like working at Netflix. You can see reviews. You can see how many people approve of the CEO. That's a really high rating, anything over 90. So isn't Netflix here we go. I've got to log back in again. I'll just move that off the screen so no one can see all of my login credentials. Okay, so isn't Netflix a narrow moat business? Yes, that's a good point, Vitek. So Netflix, I remember walking into Daphne. We won't be covering ETFs today. Go back and look at last week's live on the SelfWealth YouTube channel, or next week we'll be doing some more ETF stuff. So Netflix is actually in a very competitive environment. We just talked about that because we talked about how the business is actually, facing some competition from other businesses like Amazon and Disney, etc. And so the reality is the way narrow moat ratings are calculated, and the way moat ratings are calculated is they compare, if we come into the ratios, so what they do, at least at Morningstar, is they compare this margin here, the operating margin, right, versus the cost of capital or the interest expense. And so what they're comparing is how much profit on an operating basis does this company make versus the cost to get the debt to invest in that business, or the cost. It's a really academic thing, but I prefer instead to focus on the gross margin for a business like this and the revenue growth, because if it gets that right, the rest of it should be able to be managed. The way I think about it, Vitek, is if your gross margin is really wide, so really good, that is the unavoidable cost. But further down, you have the costs that you can vary, the variable costs, otherwise known as expenses, like marketing. Those are really interesting things. Okay, so just want to say thanks for this financial education as a millennial. God knows we need it. North Star, you're very welcome. So investing boatloads in content. Yeah, so for Vitek, I would say that of the big streaming companies, I'm just going to cut to the chase. I would say of the big streaming companies, Netflix is the most vulnerable of these companies. Now, the reason I say that, this is just my opinion, is that you're right. Companies are entering this market. Companies like YouTube. YouTube is watched by more people in the world than every television station combined. And Netflix also offers its own original content now. We also have things like Prime Video, Amazon, obviously, for those of you that use it, Amazon, Disney. But what I would say to you there, Vitek, is also consider that, in the past, we would pay $50 or $100 a month for Foxtel. Remember that? We would pay $50 or $100 a month for Foxtel. And it would be linear, meaning that it would be like, this is the thing that's being showed at this time of day. You can't choose. You just got to go with what the broadcaster tells you to watch. Now, that would cost you at least $50, maybe $100. But you can get all of these for the same price. So Netflix's share doesn't have to be 100%. But you are spot on, I agree with you, Vitek, that you've got to take into account the costs of them reinvesting in things like Stranger Things, Mindhunter, all of those things. So that is where it comes back to looking in here, keeping an eye on that operating margin, keeping an eye on all of the latest trends in the industry, seeing which providers are getting which number of subscribers, is it still growing, and the like. There's actually a great thing if you go into the Netflix 10Q, which is the annual report, you'll remember. at the very start, there's a risk section. And Netflix has to, under American GAAP accounting law, it has to spell out who the key competitors are and what their strengths are. And so this one here, you've got to pay for. But you can see here, Statista does a great job of weighing up the market and showing you, there's actually a really interesting line in here that shows Netflix subscribers are a loyal bunch, with the majority reporting that they would keep Netflix even if the monthly subscription price increased. And subscribers also stated that they would continue using the service with ads. Imagine Netflix with ads. So what's really interesting is, and this is going to be the last thing I talk about on Netflix today, but if you come back in at the very start of this show, I said if a company's got a wide profit margin, it's got a wide moat or it's a competitive advantage, it should be able to retain customers and increase prices. If you're a Netflix subscriber like I am, you would know that Netflix has increased prices. And I'm still a subscriber. I don't know about you, but that is a sign that I'm not willing to give it up. And it means that if I would hang around, they're just going to keep slowly increasing the prices. Even if it's let's say Netflix for round figures charge $10 a month, right? That's nothing for most of us that are buying shares and investing. We're very fortunate. But if they increase that to $11 a month, $1 increase, we're still like, that's nothing. It's 2 cups of coffee a month, right? But if you think about it, Netflix's yearly growth in revenue is not $1. It's actually $12. Because it actually would mean that they're increasing 10% revenue every year. That's just from the current existing customers. So when you look at revenue growth rates, like you can see revenue in here, think to yourself, in your mind, think to yourself, if they're growing revenue at 20% per year and they're increasing prices at 10%, that means that the other 10% is come from new subscribers. You get me there? So 20% growth overall, they've increased prices 10% on existing customers, and so that the last 10% must be from new subscribers. That's the way I break down revenue growth when I do my forecasts. It's a little handy hack. So Stevie says, at the ads part, I would call them out on. The majority of people, including myself, get rid of ads. Yeah. So one thing, Stevie, to keep in mind is with streaming services like Netflix and all them, is when they go into countries like India, Latin America, in that continent, they go into Africa, they can't afford to offer their service because people aren't going to pay $11 US a month or $15 US a month. So what they have to do to enter that market is they offer ads. So they can still offer a product there, just not the one that you and I are familiar with. And then in the US, companies like Hulu have talked about doing this, offering a product where they can effectively just pay a reduced fee, so like $5 instead of $10, and take some ads. And so it's just a way for them to kind of like horses for courses, I guess. Okay, I've pretty much run out of time, but let's go to A2 Milk. If you have any companies for me to look at next week, guys, please drop them in the chat now, because next week I will be getting on top of that, and we will be going back through some companies as well as some ETFs. So here we've got, let's drop into A2 Milk. A2 Milk is the company that offers A2 Milk. For those of you who notice the A2 Milk in the supermarket, you'll know that they also do other things like infant formula and the like. So I'm just going to download this. Let's just drop that here. So here we go. We've got A2 Milk's annual report. Now, we might actually stay in the SelfWealth platform for this, because I'm actually going to show you something. And this is going to relate to what we had before, right, guys? So we're already on A2 Milk. We're going to go down into ratios. Tesla, David, awesome. Love it. FDV, also like it. Plant One, awesome. Chalice Mining, Stevie, can you tell us what you mean by Chalice Mining? Naveen, we were going to cover Apple today, but everyone voted for Netflix. So surprise, surprise. Okay, so here we are. We've got A2 Milk. We're going to come down to margins, and we can see here, look at this operating margin. 10% compared to Netflix's, was it 20? Totally. Nuix, Mwanza, Echuca, Nuix, NXL, oh, yeah. Wonderful. Next week request. Disney, says Maddie. Disney next week. Yeah, I covered Disney on a podcast ages ago. You can Google my name and Disney and it will come up and you'll see it's actually a really good way to learn about Disney. So operating margin, only 10%. So that's a lower margin. Now, you might be saying, oh, hey, Owen, actually, the operating margin over 5 years is actually 26%. So this is where the operating margin is going backwards. If the average is higher at 26% than the current rate, it's actually gone backwards. And the reason is because the A2 milk is actually struggling because it can't sell into China. The Daigou channel has gone. And Chinese-made infant formula is winning share in China, not Australian companies. So we actually did a really interesting write-up on this on our website, Rask Media, and what you actually find behind the scenes. So A2 Milk, really interesting company. As you can see here, revenue was down 30%, again because of the COVID restrictions and because people can't travel. A lot of A2 Milk and infant formula was actually being sold in Australia via students and via ordinary people and then shipped to China. That's basically closed down. It's still making a profit, which is great. It's still got $875 million of cash. That's huge. Operating cash flow is still up. You can see that a lot of the metrics are good. I love A2 Milk. It's the milk that I actually buy. I pay the extra amount every month or every week. And I love it, but we're going to go to the comprehensive income statement. I know we've got only a couple minutes to go, guys, but I'm going to try and zoom through this. Comprehensive income. Let's go like that. They don't have it. Okay, so let's try it down here. Okay, here we go. Okay, so the first thing, if I'm looking at a company that's isn't growing any longer, the first thing I want to do is I want to come in here, guys, and I want to look at the cash flow statement. I want to get this top third here, known as the net cash flow inflow from operating activities. $89 million is what they made. And then I want to subtract this line item right here, the $64 million. Why do I subtract this from this? Because this is saying how much cash did the business make and how much did they have to invest to stay in there. So $64 million. Now you might exclude some things if you wanted to, like you might exclude some of this, but if there's anything in here that you think is going to occur again and again and again in the future, you exclude that from this figure to determine the free cash flow of the business. Leanne T asks about IBV, the IBV ETF. Great question, a great ETF to look at. So ASX IBV, yeah, great ETF. Another one is VTS if you're looking in the US, but it's not Australia domicile. So yeah, okay, Bitcoin. Stay tuned. We may actually look at different things like that. I know SelfWealth are interested in that. FANG on the NASDAQ. Yep, we've obviously covered one FANG today. The other company that we had was FMG, Fortescue Metals Group. Here's a fun fact about Fortescue Metals Group. Wow, down today, but that's okay. What is actually interesting about Fortescue Metals Group is that it's actually got this humongous opportunity in hydrogen. Imagine that, an iron ore company run by a guy that everyone thought was a cowboy moving into hydrogen. What are the chances of that? Now, Andrew Twiggy Forrest is one of Australia's wealthiest people. He is also one of Australia's biggest philanthropists. So he gives a lot away. People have different opinions of Twiggy Forrest. From what I've read, I actually read his book, Twiggy. It's a book about him, a fantastic book on one of Australia's entrepreneurs. Now, if we look here, revenue here from Fortescue has been going up at an incredible rate. But what you'll also notice, now if we come up the top here, you actually notice that revenue actually did dip along the way in a big way. I remember in 2017, 2018, people were saying Fortescue was going to go bust. But you can see it kind of bounced off the bottom and went up. Yeah, great point, Howard. Sorry, I should have mentioned that. Fortescue has gone ex-dividend today, which means that it's paid out its dividend and the share price has adjusted. So that's why this is down. The dividend was $2.11, and so that's why it's down. So it's not actually that big of a deal. Sorry, I closed over that point. But you can see here that Fortescue's revenue has gone up, and that's because iron ore prices have gone up. If we look at gross profit margin, or gross profit, we can see, look at that. This is what happens when revenue keeps going up, but the costs stay the same. Imagine in 2018 if you were lucky enough to buy that. Fantastic. So there are some, okay, so we've got Andromeda Metals. One final thing on Twiggy Forrest. If you read the book Twiggy, so Twiggy, he's the founder of Fortescue Metals, he actually failed a lot. before he made Fortescue Metals a success. He failed a lot, and a lot of his investors would have got hurt along the way. But he's actually proven to be one of Australia's, at least if you're into mining, one of Australia's mining entrepreneurs. I would just say if you're forecasting or you think of investing in Fortescue, two things to keep in mind. One is, where do you think the iron ore price will stabilize over the next 5 years? It's obviously been very, very strong because of iron ore prices, and that is what's led to the increase in revenue. Keep in mind that iron ore is all about supply and demand. If there's enough demand from China and there's not enough supply, then prices are going to go up. It's economics 101. But what we've had in the Americas, in like Brazil, is we've had lots and lots of tragedies from, unfortunately, from things at iron ore mines going wrong. So that took a lot of the iron ore supply off the market. We've also seen that the Chinese government has invested in an iron ore project called Simandou, I believe, which could be one of the biggest iron ore mines in the world, and that will lessen its dependency on Australian iron ore. So you've got to keep that in mind too. And finally, the second thing is the hydrogen element. How can Twiggy and his team make Fortescue's costs level out and make it a more sustainable business? So I'm going to switch back to the main screen now. So we've covered some great companies today. In summary, I want to go just quickly through those 5 points of a checklist. Firstly, determine what your circle of competence is. Is your circle of competence like mine? Is it in technology? Is it in finding cosmetics brands? Is it in ride sharing? Is it in anything that you're passionate about? If you've got a satellite at home, a telescope like this, do you like gazing at the stars? Well, maybe there's companies that are involved in that. The second thing is, we're looking for industries that are growing. So industries like in Netflix's case, streaming, we want growth, we want growth, we want growth. We want industry growth, we want companies within that growing. We want management alignment. So I showed you how to use Glassdoor there. Just go on, see if the CEO's got a good rating by employees. If you're in Australia looking at companies, use Seek. Don't use Glassdoor because it's not as accurate. Use Seek. Go to the company's page, find in there, stalk them on LinkedIn, stalk the companies on LinkedIn. Find the CEO and make sure when you look through their annual report that they have shares in the companies they run. They don't always have to, but it's generally a good sign. The other thing that we're looking at is a reasonable valuation. So what do we think revenue and profits can be in the future? So what have we got? Reasonable valuation. We've got a moat rating. We want, or not a rating. We want to see that the company is capable of generating stronger returns in the future. And so the way we do that is we determine, has this company's products or services being replicated? So a good example is Coca-Cola is still charging more than Pepsi in some places around the world. We've got Amazon, companies that keep the cost low. That's its competitive advantage. We've got companies like Fortescue that happen to be a really low cost supplier of iron ore. So we want to find these companies. Even companies like A2 Milk that are not growing this year, we want to find, it's the only true A2 Milk brand. It's got some copyright around that. So those are just 5 things that you can use to do your research. You can jump onto SelfWealth. You can jump across from ASX to global. Indeed is greater than Seek, says Stevie. I think that might be a bit controversial. But guys, thank you as always for joining me. I hope that your investing over the next week is really fruitful. You can watch all of these on replay on the SelfWealth website or subscribe on the YouTube channel. You can find us on Twitter, on Instagram, on Facebook, #SelfWealthLive. I'll occasionally monitor those. You can find me on Twitter, Owen Rask. It's always my pleasure to be with you. So thank you so much for jumping on the chat today. Next week, we're going to be talking about ETFs, and we've got some other ways and companies to think about, like ways to research companies. So Chanda, you're very welcome. Always a pleasure. Thank you for everyone that dialed in today. See you next week.